We have a very, very important topic today. And so as you can see, this is African countries probably are the countries that we are concerned about two things: borrowing, public debt issue, and natural resources issue, and of course, resource curse problem, and that is related to commodity price, the volatility of the commodity market. So our presenter today is Dr. Stella Muhanji, and I'll just call Dr. Muhanji Stella in the following session. And Stella is a financial economist with quite a lot of experience already. And she is now a senior lecturer and chairperson of the Department of Economics at Laikipia University, Kenya. And Stella got her PhD in financial economics from the University of Witwatersrand, South Africa, and some time ago already. And she got her master degrees, I think Master of Science in Economics, and also a Bachelor of Art in Economics, Business, and Mathematics from the same university, and that was from Kenyatta University, Kenya. And she has done quite a lot of research on different topics, but surrounding financial economics and stock market, and of course, natural resources. And I think she mentioned something that we should mention. And for example, the publications that are on infrastructure threshold and economic growth in Africa, which I should read. Actually, I am very interested in knowing the threshold. So whether or not there is a threshold. And also, she has done something on insider trading laws in emerging markets and the relationship between natural resource endowment, institutional quality, and external indebtedness of African countries. And I think the title today reflects one of the substreams that Stella has been working on. And obviously, this is a very, very up-to-date topic. We are also doing something very much related in a recent working paper. Actually, the postdoc from the center, we have done the government sovereign risk and the impact of sovereign risk on China's infrastructure investment, and also the government bond market, the government bond yield. So I'm very interested in knowing more, and I guess the colleagues who are here today, and I heard there are more central bankers. And so let's give the floor to Stella, and thank you very much for contributing to our research seminar. Stella, the floor is yours.
Okay, thank you very much, Hong. So the topic for our current research is on cost of external debt and commodity price cycles, the case of African countries. And one of my co-authors is here, Issouf, and we are also working with Kalu. It is an extension of the other research that I've done on external debt. And in this particular study, we look at the link that exists between external debt and commodity price cycles. Now, we know that in the past, developing countries, including lots of African countries, borrowed extensively to purportedly finance their development. And that happened when commodities prices were high. We know that in the 1970s, we had high commodity prices, and during that time, most of the developing countries accumulated debt. And so we are saying that the high commodity prices reflected favorable macroeconomic prospects for those borrowing countries. And that is why during that time, they accumulated more debt. Now, this episode, it later led to the debt crisis that we saw in the 1980s, when most of the developing countries were now struggling with the debt at a time when commodity prices plummeted. Now, apart from that time, when we had the tension between Russia and Ukraine, and this one spurred a surge in energy and food prices with unforeseen consequences for vulnerable developing and emerging market economies, including external debt sustainability problems, we saw again emerging market economies and also developing countries being affected by the war, because most of them were relying on energy from Ukraine and also for some of their food. So in that case, this one also created another problem when it came to commodity prices. So given the nexus between external indebtedness and commodity price movement, we are saying that there may be a significant link between the borrowing costs of African countries and commodity price cycles. Again, what we are saying is that if sovereign debt rating is, for instance, objectively meant to reflect a country's creditworthiness, then it means that African countries whose macroeconomic wellness have been shown to be linked to movement in the prices of their natural resource endowment should reflect a link between their sovereign credit rating and their commodities price cycles. What we are saying is that if the commodity, during times of commodity booms, those are periods that are known to indicate macroeconomic wellness of African countries, then it means that when we look at the sovereign debt ratings for African countries, they should also be linked to the commodity price cycles. Researchers have observed and documented that an African borrowing premium seems religiously imputed onto the country's cost of external debt. And of course, this can be found in Eaton 1986, Ojah 2014, Weyer and Say 2015, Olabisi and Stein 2015, and also Senga et al. 2018. So the question we were asking, could this African borrowing premium be an artifact of misspecification that also subsumes the effect of commodity price cycles on the cost of external borrowing? This is one of the questions that we try to answer in this particular research. We are saying that understanding the nature of this linkage would contribute to ensuring that the external indebtedness potential effects are less dilapidating going forward. And therefore, our objective was to explore the potential relationship between sovereign credit spreads, and this one we are going to imply it to mean the sovereign cost of borrowing and commodity price cycles. And we also seek to understand the most important channel through which the linkage is effectuated. Because though we know that the commodity price cycles affect the debt, which other channels can it affect the debt? And so we checked whether that channel is via the potential collateral value of high prices of commodities, or is it via the exchange rate of these countries? And if we go by the foreign exchange earnings for the natural resource rents of commodity exports, a resource endowed state is also naturally collateral endowed. We are saying that if the country is resource endowed, then it is collateral endowed. And if it is collateral endowed, how does that affect the cost of debt for these countries? And the higher the price of the resource, the higher its collateral value. Accordingly, the cost of external borrowing should be inversely related to the direction of commodity price movement. So for us to have an idea of what we were putting forth, we plotted some stylized facts for Africa countries. We started with commodity price and the spread or the cost of debt, and we noticed that there is counter-cyclical relationship between the two. And in the periods of commodity booms, we see that the commodity price cycles are above their cost of debt, apart from 2009, when we had the financial crisis. We also plotted exports, which are collateral for African countries, and the spread. And also we notice a counter-cyclical relationship between the two. For the debt service as a percentage of exports and the spread, again, we notice a counter-cyclical relationship between the two. But when it comes to percentage change in GDP and the spread, we see a co-movement between the two variables. We see that as their economies are performing well, their cost of debt is also increasing. We now compared with the emerging markets and see how do the African countries fare compared to emerging markets. When it comes to their commodity price cycles, they move together in the same direction. They move in tandem. There is co-movement between the two variables. But when it comes to the spread, here we notice that the African continent, the cost for the African countries, the cost of debt is higher than the cost of debt for emerging market economies. And therefore, at this point is where the question we were raising, do African countries pay a higher premium? Here we notice there could be a possibility that they actually pay a higher premium compared to emerging market economies. When it comes to performance of the economy, we notice emerging market economies are performing far much better than African economies. For collateral, we note that before 1998, the collateral for African countries was higher than the collateral for emerging market economies. But thereafter, emerging market economies have had higher collateral compared to African economies. So with that, we decided to run our analysis and see which of the how commodity prices affect our spread. And for this particular analysis, we said that spread is a function of pull factors and push factors. For this particular study, the pull factors were the commodity price cycles. Then we interacted commodity price cycle and collateral so that we are able to determine if the collateral, how the collateral channel affects the cost of debt. We also interacted commodity price cycles and the exchange rate so that we can also be able to determine how the exchange rate channel affects the cost of debt. And then we also added more pull factors to our analysis. That is the external debt capacity, which is the total reserves plus exports divided by GDP. We also included the degree of financial development, macroeconomic stability, which is proxied by the inflation rate, the S&P credit rating, and the business cycle. The push factor that we included in our analysis is the global volatility index. And this one represents investors' risk appetite and international markets. Now, for our data, the period of analysis is 2000 to 2021 for 19 African countries and 16 emerging market economies. The 19 African countries were selected because they are the only ones that had available data on spread. The rest did not have enough data. So we went for those that had data. And data on volatility index and financial development were collected from IMF. And that of bond spread was drawn from DataStream and JP Morgan database. The macroeconomic variables, most of them were collected from World Bank's World Development Index. Commodity price data was collected from IMF's International Financial Statistics Commodities Database. And the African countries we included in the analysis are Algeria, Botswana, Cameroon, Cote d'Ivoire, Egypt, Eswatini, Ghana, Kenya, Mauritius, Morocco, Mozambique, Namibia, Nigeria, Rwanda, South Africa, Tanzania, Tunisia, Uganda, and Zambia. And the emerging markets that we included in the study are Argentina, Brazil, Bulgaria, Chile, Colombia, Croatia, Hungary, India, Indonesia, Malaysia, Mexico, Pakistan, Panama, Peru, Philippines, and Poland. We left the Asian countries that are doing very well because we didn't want them to sway the results. Now, for the first set of results, where we ran analysis of commodity price cycle and cost of debt of African countries, we had 3 sets of analysis. The first one, we have the panel linear regression. And for this one, we have 2 models that we were running. One in which we entered financial development index, and then the other one we had credit to private sector. The 2 variables were highly correlated at 0.89, and therefore we entered them interchangeably in our regression model. Then we had the panel linear regression with GDP. This one we left out GDP. This one we added GDP, which represents the business cycles. And then we had the GMM regression because we wanted to address possible indigeneity in the data. From our results, here for this model, percentage change in GDP was the endogenous variable. We noticed that commodity price cycles reduce the cost of debt for African countries. And this one points to the importance of commodity being used as part of collateral when you want to determine the debt of African countries. When we interact commodity price cycles with collateral, we notice that it reduces the cost of debt, and this is consistent all throughout. When we interact with the exchange rate, we notice that the exchange rate channel increases the cost of debt. And we know very well that African countries have their currency, when they sell their commodities, they sell in foreign currency, not in their own currency. And therefore, we find that the exchange rate then ends up leading to an increase in their cost of debt. Now, so what we are saying from the results that I've just presented is that the commodity price cycle, we've seen it reduces the sovereign bond spread of African countries, and therefore they also reduce the credit risk. And of course, for the collateral channel, what it means is that the increases in commodities prices influence the collateral channel increases commodity prices, influence in tapering down African countries' borrowing cost. So we see the collateral channel is very important when it comes to reducing the cost of debt for African countries. But when it comes to the exchange rate, we are saying that it increases their cost of debt. And of course, it's because of the fact that the exchange rate is highly depreciated and therefore increases the default risk and consequently increases the cost of debt. That is what we are getting from that data. Now, next, we wanted to find out, what about emerging markets? What is the story? For emerging markets, when we ran the analysis, we see that the commodity price cycles of emerging markets lead to an increase in their cost of debt. But remember, already we know the cost of debt for emerging markets is lower than the cost of debt for African countries. When we look at the collateral channel, again, just like the African countries, the collateral channel reduces the cost of debt. The exchange rate channel also increases the cost of debt for African countries. Then we also decided to run a third set of analysis. Here, we combined all the countries together, but we introduced the region dummy, where the African countries took the value of 1 and emerging market economies took the value of 0. And we interacted this dummy with commodity price cycle. When all these countries are lumped together, we notice that commodity price cycle increases the cost of debt. But when we interact cost of debt with the region, here we are saying how does commodity price cycle affect the cost of debt given that the country is from the African region? And we notice that it reduces the cost of debt. But then when we combine all of them together, we see that it increases the cost of debt. Collateral channel consistently reduces the cost of debt, and the exchange rate channel consistently increases the cost of debt. So what we are saying is that when we look at the region dummy and the fact that it reduces the cost of debt, then it indicates that African countries' premium is higher when compared to that of emerging market economies. And therefore, we can say that the outcome of testing the so-called African premium appears to support our suspicion that it may be partly be due to misspecification, such as neglecting the price increases of Africa's mainly primary goods type exports, arguably the principal foreign exchange earner of most African countries. When we determine the cost of debt for African countries, we are neglecting the fact that their commodity prices are important. Even though they mainly trade in primary goods, that what we are saying that the commodity prices also matter for the African continent. So what we are saying fundamentally, we've documented that commodity price cycles are a robust antecedent of sovereign bond spreads in Africa. Furthermore, the two postulated channels through which commodity prices could affect bond spread, that is the collateral effect and the exchange rate effect channels, are indeed relevant conduits. The collateral effect contributes to reducing bond spread, whereas the exchange rate effect reflects a weakening currency outcome versus the income effect of commodity exports. And we are saying that this latter outcome is not surprising given that African countries notoriously have low relative currency values due to high import demand and associated low terms of trade. Of course, we know the African continent is disadvantaged when it comes to terms of trade because of the nature of their exports and the fact that they import goods that have of higher value than the exports that they export. Interestingly, the so-called Africa premium is attenuated by properly accounting for the role of commodity price cycles in the creditworthiness of countries and thus their resultant sovereign bond spread. Thank you.
Okay, thank you, Stella. That was a quick presentation, and it looks like a complicated paper, but you did it in a very concise way. And thank you very much for that. I'm sure there are a lot of questions. So although we know what we heard from you, but there are some details probably people want to know. So I would like to open the floor in the first instance and to hear from colleagues in the audience. So do I have a hand here? Okay, so let me start. So so the research question is, to me, is a stylized fact already, and because the nature of the African export extractive nature, so they rely on exporting natural resources, and therefore the commodity market comes to the picture, and then the volatility in the commodity market, of course, is relevant for African countries, for their public debt, let's say it that way. And this is already known. And what you did is to check. Of course, there are some regional distinction between African countries and other emerging markets, and which is interesting, probably if you go further. And apart from that, you introduced the two channels. So you checked the collateral channel, and you also checked the exchange rate channel. And you found that the collateral channel, as we imagine, as we already, assumed that reduces the cost of borrowing, but the exchange rate has a negative impact on the cost of borrowing. So I'm not an international finance person, but I think this is I'm a capital market person otherwise, so I know what you are talking about. And first of all, in your sample, you used 19 African countries, and you are talking about African premier. So the first issue that came to my mind is the selection bias problem. So and you said that there's no data for other African countries. But if you do not deal with this selection bias problem, can I say that cost of borrowing may be caused by some other country level characteristics that are common across all African countries? So how do we do this? Even though you do not have the data for other, how many? Maybe 30, over 30 remaining African countries. But how do you, maybe you can use the two-stage models to deal with the selection bias problem in the first instance, and then in the second model, you can go down to what you have done in this paper. So that's my first thing. So I'm just thinking nowadays, if you want to publish something, and this type of, African countries, they do perform similarly in terms of their public debt. How do you take care of the country level characteristics? So you need to get rid of other common characteristics so that you can call what you have obtained as African premier. So that's my first one. And the second one is about a little bit about the theory. So I very often I was looking for underlying theories, and you made the connection between commodity prices and with the cost of borrowing of those countries, and you did not really go deeper talking about the underlying theories. So if you can explain a little bit more about the theories. And I have another comment on this collateral channel. we do not know what the collateral is. How did you measure it? So this is, I didn't hear from your presentation. And my last one is about the policy implications. So what should they do? How do they make policies that they can help themselves and they can consider this volatility in the commodity market? And what about the implications in terms of resource curse problem, for example, and in general, resource allocation? So whether or not they should still rely on exporting natural resources for their avenue, and those avenue probably not, they do not necessarily spend those avenue on something that can promote economic growth. So how do they do according to your research? So that's my comments, my impression that I got from your presentation. Stella, if you can.
Okay.
Yeah.
If I can respond to them. Okay, my co-presenter is here. Issouf, do you want to say something first?
Oh, no, go ahead, Stella.
Okay, so for the measure of collateral, that one we used export revenue as a percentage of GDP as a measure of collateral for the African countries. Because we know very well that when they are repaying their debt, they use, most of the time it is measured by the exports, or they use their exports to repay their debt. So we used that as their collateral. Is that fine?
Yeah, I'm thinking you already have something related to your export, right? So you have this commodity market price. Are they related?
No, because for the commodity price cycle, this one is the net export price, and this net export price, I got it. It's the one that was formulated by Gross 2014. That is the one that we used, the IMF index for commodity price. But then for collateral, it is the exports over GDP. Yeah, so they are not the same. And they were not correlated when we looked at the correlation matrix, they were not correlated.
Okay.
Yeah. So then the other question that you had, it was on the part where you mentioned about the bias in the selection bias in terms of the results. What we did, because of course, we didn't run the two-stage least squares, but we ran the GMM analysis. But there is also another part of analysis that we were working on, which was the Bayesian analysis. And the Bayesian was because of the small sample size to see how it affects how the results will turn out. Preliminary findings are telling us that in terms of the coefficients and in terms of the signs, we maintain the same. And that one will come in, is supposed to come in as robustness checks. And of course, for the two-stage least squares, thank you for that suggestion. We will add it because it's still a working paper. We'll include it as part of the analysis.
Okay, so let me respond immediately. So I think for the sake of understanding better, so so the sample selection bias is not the two-stage least squares something. So samples, you said you use the GIM, but GIM deals with the endogenous problem mainly,
yes,
partially. But sample selection bias problem is a different issue. So here you use, so you have 56 African countries, and you only use 19 countries that you think they have the data. You just picked those 19 African countries, and then you derive some conclusion, and that conclusion, you call them as African Premier. And if that is applicable to other African countries, we do not know. So therefore, I think other African countries should be used as the counterpart. Let's say normally we say there is a treated group, but there is a control group. So when I say two-stage least square, two-stage model, I meant actually the Heckman two-stage selection biased model. So I'm sure you heard of that. I'm not so sure I understand what the Bayesian procedure can solve those problems, but I just want to highlight that sample selection bias problem. It is very obvious. So that's so you can continue with some other. I saw a hand. Is that hand very urgent? Shula, can I invite you if your question is about this econometric procedure? Shula?
Okay, thank you so much. Yes, I was saying that my question is also relating to the methodology. So you showed us three models, I think, which I think you sort of glossed over. It would be interesting to know what you're doing in model 1, model 2, and I think the GMM. And on the GMM, I just wanted to understand what the sample size is. You have 19 countries and the data coverage is for what period? Sorry, I didn't get that.
2000 to
2000 to 2021.
To 2021, yes.
Yeah, so there's a fundamental issue there with the GMM, because you can only use the GMM if your N is larger than the time series. Yeah. So I also wanted to make that comment. Maybe you can provide some clarification. Thank you.
Yeah, thank you. Stella, now you have an extra question. Yeah.
Okay. So there was also another question. On the commodity prices and cost of debt, the theories that are underlying.
Yes. Yeah.
Yes, the ones that we applied for this particular case. And if I look at it, we went straight to the theoretical model, and we were applying Wits' model for our research. I think that was a small oversight on this paper, and we'll be able to add it to it. Mm-hmm. Issouf, do you have anything to say on that?
Yes, on the theory, let me just, thank you very much, Ong and also Shula, for your comments, and suggestion, actually. Yeah, to come back on this sample selection bias, of course, Ong, as you mentioned it, yes, probably there is a sample selection bias, but I don't think, basically the main message actually is still there, right? When you compare those, the premium, the premium, actually we can observe on this sample of African countries and the samples of emerging market countries, actually we compare. Of course, from there, can we actually make a generalization to all Africa? Probably this is a question mark. I agree with you actually that we cannot make a generalization to all Africa at the same time. But at the same time, actually, if you look at on this literature, especially the spreads of the bonds, usually, I mean, we are constrained most of the time by the debt on this trade, actually, because you can't really actually get the spread on the debt of all the countries. And then this is actually the constraint that make us actually restrain, I mean, the data to the 19 countries, actually. But I do agree with you that, I mean, actually, from these 19 countries, we cannot make a big generalization to say that it holds necessarily for all the 50, I mean, or 52 African countries, actually. Probably, I mean, we have to be clear on that, actually. In terms of theory, okay, actually, it was because, I mean, Stella, I mean, did a very good job, actually, in terms of presenting. She wanted to go straight to a point. But actually, in the paper, we have a theoretical path, actually. We have, I mean, we have a theory based on the model, I mean, which actually exists. Basically, it goes from the fact that in this literature, you will see that basically we classify the factor which affect, I mean, the spread on the country's debt as the pull factors and the push factors. Basically, some of those factors are basically they are factors fundamental to the countries, and then they are factors external to the country, which actually the country has less control onto that. And then we went through this type of model actually, and then we're able actually to justify why actually the commodity channel and the exchange rate channel also should be actually some of those factors which will actually affect, I mean, the cost of the spread of the debt. Then we did that. We have a theory, I mean, underline it, but in the presentation, I mean, actually it didn't come out clearly. That's why maybe, I mean, it gives you a chance, the feeling that, I mean, there is no theory actually, but we have a theoretical model, I mean, on the paper.
Okay, so I know why I need to leave time to colleagues, but I still did not hear that much about the underlying theory. For example, now you are making the connection between commodity market uncertainty or volatility, and between that and the bond spread, the 19 African country bond spread. And is this something related to asymmetric information? Is this something related to the uncertainty theory? And things like that. So think about borrowing behavior, and what are the factors, the standard factors that can affect borrowing. And in this case, it's government borrowing. So so I was thinking about in that direction. So so why when commodity prices is higher, African government borrowing, so the yield is lower, meaning the cost of borrowing is lower. Is this asymmetric information theory? Because higher, or is this maybe financial constraint theory? Because when the commodity prices are higher, given the nature of export, then that means that they can get more revenue, and that releases the existing financial constraints. And investors know that if I'm I'm an investor, I want to buy government bonds, African government bonds, then that reduces the risks that I'm facing. So I'm thinking about that in that direction. But I think let's talk more.
Yeah, but you can link that to even, I mean, the credit rationing also story, right? I mean, basically, because those countries mainly they will get resources from the commodities to be able to reimburse actually the debt. Then when the commodities are prices and also what we talk as actually collateral actually, then this is give a signal. It's a signal actually to the market actually say that the country will be able to pay back. And if you look at many of those countries, you will see that there have been many of those countries which have been a reality. You are seeing a surge in the borrowing of many of these countries where we're at the same time the booming of the commodities, I mean commodities prices actually. right? Because the perception is that basically they will be able, I mean, actually to pay back because of the, I mean, the underlying which are the commodities as collateral as well, actually.
Yeah. So we are getting here. We are getting so the credit rationing and capital marketing perfection theories and etc. And I think that's something if you can add into your paper explicitly, that will enhance the possibility of being published.
Okay.
So
Thank you.
yeah. Okay. Thank you very much, Issouf. I know we have some common language. So Stella. What about the remaining? Do you have any other things? Oh, policy implications, for example.
Yes, the policy implications for the paper. I think these ones we will. What we had only indicated was the need for commodity prices to be factored in when it comes to determining the collateral of African countries as part of our issues of policy. But we can add more. Remember, it is still a working paper, and therefore we still have time to add more.
Okay, that's a very clever answer. And Issouf, do you have anything to add?
Yeah, but thing I want to add is on the exchange rate channel actually, and then that's why there are some initiatives actually, and then there is some voices on the continent actually to have basically those exchange rate risk. I mean, hedging, I mean, instrument on the continent, because basically, I mean, the currency of many of these countries are really highly related to the prices of the commodities. And when the commodities prices, I mean, falls, and then you see that there is a lot of volatility on the exchange rates on the country. That's why, I mean, there are more some initiatives actually try to get, I mean, hedging instrument for local currencies actually, to local currency. Even, I mean, there are even, I mean, voices to really encourage much more borrowing in local currencies actually as well, right? I mean, but this, I mean, this can be discutable because if they are going outside, I mean, the local market to borrow outside is probably because of the market. I mean, the size of the market doesn't allow them, I mean, actually to collect all the funds they need actually. Otherwise, I mean, there is also, I mean, this recommendation also to try really to have develop much more the domestic linked actually borrowing market actually, right? And that we can discuss that, I mean, even more, because if you look at some of the constraints in many of these countries, you see, for example, the pension funds and so on, they are sitting a huge amount of money, but which are not used, I mean, the financing of the economy, actually. But those domestic, I mean, mobilized funds, if they can be used actually for a development project in some of those countries also, why not actually? And then it will really edge them against, I mean, going outside and then borrowing from the international market, which expose them to exchange rate risk actually.
Okay.
There was the last question on the GMM, the fact that
yes.
the sample size, the number of countries should be greater than the period. If you look at our sample, with the 19 countries, and if the sample begins from 2000 to 2021, we are talking of 21 and 19, it was not very far from each other. It's not a case where you have a very large time series and very few countries. We are almost there.
Yeah, you're almost, but the problem is in GIM very often your number of cross-section units should be much larger as compared to the time. So that's I think that's the point that I think was raised by Shula. You have something to add, right?
Yes, Professor, I wanted to add that it's a big methodological issue. Actually, you are dealing with a case of small sample. So 19 and 21, those are small samples. There are alternative methods that you could use. For instance, you could use the feasible GLS. It will do the same thing. It will bring out the issues you want to bring out. You could also use the DISC-CRO-CRO. This is what literature has put across. It's not a matter of closeness. I think it's a matter of principle, as I understand it. So I just thought I add that. Thank you.
Yeah, thank you. And
Thank you.
so, Stella, do you think you're okay with these comments, additional comments?
Yes, 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 yes.
Can I
We'll
add one
add.
more thing? I actually did my whole PhD based on GIM, but now I do not use GIM anymore. And I would rather use a two-stage least square, the I-way. So do you think it is possible to find an I-way for your research? If you can find a good I-way, and I think that will be even, you just add another set of robustness test. So that shows you can treat your endogenous problem much better. That's my additional comments on GM, particularly given that you only have 19 cross-section units. And so normally people have thousands, and you know what I mean. But that's my additional comments on GM.
Okay.
Yeah.
Thank you. We'll
Yeah.
include the instrument, the two-stage least squares and the instrumental variables
I think
regression
if you can,
as part of.
if you find the instrument,
Yeah.
that will be more appealing. I think.
Yes, I will.
Yeah.
So
will
I need to
add
open the
that.
floor.
Yeah,
Please.
just to come to the GMM, yeah, that's a real good point, and we'll look at it. But if you look at in most of the regression, if you look at the total number of observations, you will see that basically there are fewer years than, the number of countries actually. If you look at the number of total observation actually, yeah. Of course, right, the sample size in the description is going off this period, but with the missing data and so on, then you have fewer years than, the number of countries basically. But good point. We look at it. Thank you.
But 19 is quite small. So
Yeah.
anyway, let's switch to some other issues.
Okay.
Colleagues, can I have your hand, please? Well, we have a lot of bankers right here. So and particularly for people who are working on African, this is an extremely relevant topic.
Yeah.
Any other comments or suggestions? So
Yeah, but while we are waiting for people, actually to intervene,
Yeah.
the main message we wanted, we wanted to really bring some contribution on this debate, actually, right? Okay, probably I will let Jonathan speak, right?
Jonathan,
yeah,
okay.
okay, right, yeah.
Jonathan, please come in. Yeah, thank you.
Sure, thank you very much, Prof and the authors. I hope that the comment I'm making is not out of line, but it's just something that continues to bother me, particularly from a practical point of view when the debt sustainability analysis is used to determine how the various thresholds might be met or breached, as the case may be. And I see that in the context of this study, you still use that framework or approach as well with respect to collateral, where you're arguing that with a price boom, you expect that to dampen the cost of borrowing by the countries concerned. That appears intuitive, but from the practical point of view, the expectation would be that the price boom will be accompanied by strengthened reserve position of those countries. But that doesn't necessarily happen.
Okay.
So it appears to me that this tends to be psychological, that the two co-vary, and therefore it gives the theoretical result. So what I would have thought is that if you look at the sample of countries you've identified for Africa, they are quite heterogeneous. Algeria definitely has a completely different history to Zambia in terms of date. Some of these countries have gone through debt forgiveness. The polite way of saying that these countries, indirectly, if you wanted, you could simply say that this country is deported. So with that kind of history, even when they are going through a commodity price boom, if they went to the capital market, or even if it was a bilateral borrowing arrangement, they'll still have a higher risk premium. So while the results appear to be intuitive in line with theory, I would have thought that country-specific estimates would be more appealing in my view. I know it will require more time for you to do that before you could generalize your result. I would have loved if you had more time to do a few country studies and see how that compares with the general result that you are getting from here. I know that if you look at in terms of Africa and emerging economies, you might get a similar result, but I suppose country-specific studies or results will be richer in terms of the conclusions and policy advice coming from this study. Thank you.
Okay, thank you very much, Stella. And do you have anything to respond?
Thank you, Jonathan, for your suggestion. We'll also consider the country. We can try the country-specific analysis and see. I agree with you. You lose some information when you have panel data and you have very heterogeneous countries. But because these are the ones we were able to get the data, we put those ones together and we decided to run the analysis with them. But as part of a test, we don't mind running the analysis for country specific, and we are able to see how the commodity prices will affect their cost of debt. At some point, Jonathan disappeared. I didn't hear what he was saying, so I didn't pick up everything that he said. But we will appreciate his comment.
We do have colleagues' hands here, but I just add that if you do the country-specific analysis, you can actually make use of the longer time series because you are talking about a general issue that actually is applicable to African maybe for a long time already. So, and you can compare maybe before COVID, after COVID, or before the war, after the Ukraine war, etc. You have a lot of room to play around if you do so. So let me give the floor to Raphael Will. Sorry.
No worries.
Raphael Will, sorry. Yeah, please, yeah.
No worries, it's Refilwe.
Okay, Refilwe, thank you.
Thank you so much. My question is relating to the issue around the sample size that keeps being raised. So I wanted to find out why you believe that there's still such a huge unavailability of data, not just in relation to the study, but generally for African countries. Is it the reluctance to share information out of mistrust, perhaps to protect their sovereignty or other reason? Is it because of the unavailability of resources, financial, human, or even competence? Or is it the lack of awareness of the importance of farming reliable data to inform optimal decisions? What are the reasons for this lack of availability of data and why we always seemingly coming across a few African countries that can be used for such studies?
When we calculated the spread, we used the difference between the treasury bond rates, the 10-year treasury bond rates for African countries, and the US treasury bond rate, which is the risk-free interest rate. Now, for the African countries, their treasury bond rates were the problem. And that the countries that we used are the ones where we were able to get that data. For the others, we couldn't get the data on their treasury bond rates.
Yeah. But I sorry, I just, yeah, sorry, away.
Yeah. Thanks for that answer, Stella. But my question is, do you by any chance know why we're still struggling with availability of data for African countries? I know it's not part of your study, but if anybody on this platform perhaps has an answer, because I think it's been going on for centuries, where we are able to progress in terms of valuable insight to optimize decisions and effectively come out of this last decade where borrowings on the African continent were high, and ever since we just haven't been able to recover, be it the inability to grow our economies and pay off debt and a whole lot of reasons. But do you by any chance know why we're still struggling with the availability of reliable data for studies such as these? I know it's a bit on a tangent, but if I may be just forgiven, if it, I'm interested to know whether
I can see one of the employees of African Development Bank, Martin Wafula. I don't know whether he can tell us something about it, why they've not compiled this data for the African continent. Martin?
So Martin, you can jump the queue. Martin?
Are you talking to me?
Yeah, so Stella is so clever.
Thank you.
So she actually kicked the ball to you. So you
Yes,
need to answer this question. Yeah.
Okay. My response to that was that because you're looking at external sovereign debt, when you're looking at the spread between the US Treasury rate, you're comparing that with the comparable rate of African government foreign currency debt, which is debt issued on the bond market. But only a relatively small number of African countries have issued euro bonds or dollar bonds on the international market. Many of them have not done so. So it's not surprising that there are only 19 African countries for which data is available. Countries like Somalia or Central African Republic are simply not capable of issuing a bond on the international market. Nobody would buy it. And therefore, that to my mind, is the reason. I mean, it isn't such a problem in terms of small sample bias, because this is the sample of countries which are able to participate in international bond markets. I mean, any other type of international debt for these other countries which are not able to issue bonds is going to be simply some sort of bilateral rate, which has been, or maybe a bank has lent to a government, and that will be very untransparent, very likely, and very, very idiosyncratic. So, that's to me the obvious reason why there's only 19 countries for which this type of data is available, because these are the only countries which actually issue Eurobonds. Thank you.
That's a really, really good point. So I actually forgot about this foreign currency bond issuance, and that makes a lot of sense. However, if you look at the credit rating agencies, maybe 3 top, they do have the credit rating for African countries, right? So for more African countries, more than 19. So is that relevant if you use the sovereign credit rating of African countries? Is that, I guess it's the credit rating scores are highly correlated to bond yield, to what you have used, right? So that's just the one thought. So we have many hands here. Stella, if you can respond, to Martin's comments and to my further question, we can allow you to do so immediately. Stella, you're going to point out another person, right, to answer the question.
Yeah. If I may, but go ahead, Stella, and I can add something. Stella, you want to add something? But
yes,
I mean, just
go
ahead, Stella. Sorry.
Yes, on the use of the credit rating, the credit ratings, yeah, we use them as the spread, or what do we use them as? Because the credit ratings are there, and we used them as part of our independent variables and not, they entered as the independent in our study and not the dependent unless we now take it up. And we use it as proxy for the spread. Then that way we will have more countries on board, because for the credit ratings, we have more countries with the data.
Exactly.
But when it came to the treasury bonds, we had fewer countries.
Yeah, but what about the domestic public, the debt market? So that's also relevant.
Yeah, but I mean, basically here, I mean, the crucial, the main problem, which put those countries more at risk are not the domestic debt market. It's much more outside debt market, actually, right? External debt market, that's what's putting more pressure on the countries, actually. But to come back to your comments on whether we could use the rating actually to infer actually the cost of borrowing, that's the whole point we are making here, basically. Because you see, there are more criticism, there are people who are vocal these days that basically there is a borrowing premium on the African country which does not really reflect the fundamental of the countries. And then there are good examples. If you take, for example, some of the good examples, you take two countries with the same rating. Some of them in Africa and outside Africa, they don't have the same spread. And why is that, right? If we believe that actually ratings reflect really actually the solvability, is an indicator of the solvability of a country. And that's the whole point we are trying to make, actually, through this paper, actually. Taking the ratings, trying to infer from that the cost of borrowing does not help, actually, because basically you can have the same rating but without really the same spread for the country, actually. But coming back to Martin's point, basically, thank you very much, Martin. We see what I was about to say. Basically, it's only recently, starting with 2000, many of these, some of the African countries actually went on the Eurobond market. Then with going on this public market, actually, we can get the spread on some of those bonds, actually. Otherwise, many of the debts are either, private type of thing and so on. Then you don't have information necessarily on those spread, actually.
Okay, so let's see, Martin, your hand is still on. Is this the old hand, or you want to add something new? Martin?
No,
Okay.
I thought I had switched it off, actually, but...
That's great. Thank you, Martin. So now we can give the floor to other colleagues. So, Sulai? Professor Sulai?
Okay, thank you so much, Professor Hong and Stella, for the presentation. I want to allude my presentation to, I have forgotten the previous speaker, but it was to do with heterogeneity of the countries under study. And in addition to what Professor Hong suggested, that doing a counter analysis would be okay, in my thinking, because of the heterogeneity of the countries and the price volatilities in those countries and other macroeconomic indicators, in my view, it would be, we normally have World Bank dataset that groups countries according to their GDP. How I wish Stella would also pick that grouping instead of having a big volume data set on panel data. She could create panels based on that World Bank grouping in line with countries' GDP. Because when you see Kenya, you see other countries, there are a lot of variation. Such kind of variation would be better if you created different data sets based on a certain key metric, so that you are able to give to make now to have your results compared. So that becomes like a comparative study, a comparative analysis. You are comparing countries in this category with those one in different category. I think by that one, it will even help you in coming up with better and appropriate recommendations for those countries that fall in a similar grouping, other than bundling up recommendations in such a kind of heterogeneity or heterogeneous countries. The recommendations won't work. You cannot, for example, get recommendations for Kenya to be similar to those of maybe South Africa or Zimbabwe or Algeria. There must be that kind of grouping from which you are going to be able to give genuine recommendations. For me, doing it for each country might end up creating a lot of problem on her side, but having a certain scientific grouping based on World Bank or IMF will work better. Secondly, I did not hear you tell us what is your base year, because of, I know it is a year observation, you are observing, there must have been a base year you started with or you took into account. What is that base year and how applicable is it to different countries which have gone through different economic issues or downtowns? Especially, many of the African countries went through the structural adjustment programs differently. I don't know which now in your case becomes the base year and why, more for different countries that adopted different SAPs at different times. So what is your base year and why, how appropriate is it that is comparing all the countries across board? And maybe thirdly and the last, there was an issue on the generalized methods moment, GMM, and I heard your defense was because they are close. In academics, this is not statistics, that because we are close, we therefore have to take it as is. We must have a certain assumption that works. GMM models have specific assumptions that they build upon. Don't say here that because it is close, therefore it is appropriate, because they were looking at the years versus. So don't say because they are close. No, you must have the assumptions of the GMM and see whether what you have fit within those assumptions. If not, you get another appropriate suitable model to use. Thank you very much.
Thank you, Shule. And I gave the floor to Stella. Stella?
Yes. So for the grouping that Shulei has suggested, that one is fine. We'll try them out. That will be part of robustness checks. We'll be able to see how the results will look like when we group them as per the World Bank classification, that is the middle income countries, the lower middle income, and if we have any low income countries, we are going to group them. Then for the GMM, I think we are in agreement. We will adjust and use instrumental variable regression model. And also the two-stage least squares, will add them as robustness checks for the paper. Now, for the base year, does Shulei want us to justify why we selected from 2000, or is it the base year? Because we started with the year where we had availability of data. We didn't have any particular reason why we are selecting 2000, because that is the data that was available for spread for most of the African countries. South Africa had a larger spread, but then the rest we were getting from 2000. So we decided we better have it all from 2000.
Yeah, so that's okay, and you justified that. I was also thinking about this 2000, as a starting point. We have another colleague. Let me try Nandalanga.
Okay, thank you so much, and thank
Please.
you, Stella. Good to see you, and I really enjoyed your presentation. Just one question, and maybe the others will be suggestion. The question is for the rating agency that was used. Did you have like a specific rating agency, or you used, or which specific agency was used? Because we have Moody's and others which use different methodologies in terms of rating the countries. And then maybe the next question is in terms of how did you control for different shocks that a number of these countries have gone through? I think the COVID-19, I think the global financial crisis in 2009 there. So how did you control that? And then lastly, in terms of our question, how did you control for fiscal policies that influence procurement of debt? Because they tend to vary from one country to the other. The factors driving procurement of debt in Uganda are not similar to those ones in Kenya. And again, when you dig deeper, you find like the use of that external debt varies from one country to the other, because country A could be having an instrument which says that if you procure external debt, then it has to be for development. So I'm just wondering how you basically control for policy issues that drive the acquisition of external debt. In terms of suggestion, I think I will go with what Professor Sule has said. It will be much easy for you to stick to the panel because that's where you have, and just motivate the reason as to why you are using a specific group of countries. And then, as it has been suggested, to follow either the IMF or the World Bank grouping of countries, and then use that. Other than mixing, doing the country level for the 19 countries, and again doing the panel, that would be a lot of work. Those can be two papers. So you can be able to, if you want to do that, then you can separate that and do it differently. Yeah, and then the suggestion by, I think there was a good suggestion by I think Shula in terms of the methodology. Yeah. So just to the others, I would suggest that the issue of the empirical strategy should be relooked into. I think there is need to change, given that. We have already seen the number of countries is, of course, less than the time, which basically affects the use of the GMM. Yeah. So those are just my suggestions and maybe some clarification in terms of the questions that I've raised. Thank you.
Okay, thank you.
Those are good questions. Let me just acknowledge those here. Stella?
Okay, thank you, Martin.
It's not Martin.
He's also Martin. He's
also
also
sorry.
Martin. There are two Martins.
You're friends, right? Yeah, okay, yeah.
The credit rating used in this study is the S&P rating. That is the one that we used. Then for how we controlled for different shocks, because these countries have gone through different fiscal policies. That one, I don't think we looked at it, but we can still have a look at it. But for your information, from the trend analysis that we had, we noticed that in 2014, that is when most of the countries they borrowed heavily from international markets, because after the floating of the first Eurobond, which was around 2012, most of the countries followed suit. So you find from 2014, their cost of debt went up and it was very high. Before 2014, the cost of debt is lower, of course, because of the HIPC initiative. Some of the countries received full debt cancellation. And I think from our sample, we had very few that received debt cancellation. And then after that, 2014 is when we see a peak in borrowing. And most of these countries were borrowing for infrastructure. It was mainly infrastructure debt. That's when they floated the Eurobonds. So in this case, then, it means and still add that, but we didn't factor in the different fiscal policies for various countries. Issouf, anything you have to say?
Yeah, no, I mean, thank you very much, Martin, for this suggestion. These are very good suggestions. Probably we need, I mean, in even the robustness, I mean, we need to control for some of those issues, I mean, raised by Martin, and then see if our results still, I mean, remain, I mean, actually. I mean, thank you very much, I mean, for the comments, I mean, Martin. And the suggestions, actually. I took it from as suggestions.
Yeah, thank you. And thanks for the comments. Those are very relevant comments, and thanks for your responses as well. Do we still have other comments or suggestions or questions from the audience? So, well, I maybe I can add two. Oh, now wait, Martin, are you coming back?
Yes, I'm coming back. I think Stella wanted me to say something about, of course, why most African countries are not having the data and what is being done. I think, yes, it's acknowledged that most African countries are having data issues, but from the bank perspective, the bank is working with most of the countries, the authorities, especially the national treasuries, to be able to enhance data collection and, of course, reporting, which could be very important in terms of usage or work like what Stella is doing at the colleagues. But my colleague, my friend, my namesake Martin provided the answer specifically to that. That I think you are limited in terms of the countries that have issued the Eurobond, and that's why you got those specific countries. Yeah. But just to say, from the bank perspective, there's work which the bank is doing to enhance the statistics for the different countries of the continent. Thank you.
Thank you for this addition. And I guess this is a kind of explanation, further explain why. And I do not see other hands, but I do have two comments that I want to add to what I commented before. So I think if you go further from econometric perspective, I think you are able to do a Heckman two-stage selection model, because now in the first stage, you run the probability model, which explains why those 19 countries, why a country can issue a bond on the international market. In that estimation, you include all 50-ish countries, but your focus is those 19, right? Probability, when they have the international issuance, and that variable is 1, otherwise it's 0. So in the first stage, you actually, this is like a treatment equation. So you consider the other African countries. And then in the second model, second equation, you can focus on 19 countries in which you use those spread. And but if there are two procedures, if you use a separate the estimation procedure, then the second stage should include the inverse the Mills ratio from the first stage, and that way, I think your model you covered two things. You covered the sample selection bias problem, and you also covered the endogeneity problem. So I think if you look at, I'm sure you have heard the publications which used those type of selection bias, Heckman selection model, and I think it is possible for you to use that. And you do not need the data for the remaining African countries. It's just the probability why they go to international market. So that's one issue. And the second issue, I think the story will become more interesting if you add some flavor in terms of the commodity market volatility. And now you have the evidence, and this is baseline evidence, saying, look, the commodity price cycle does matter. And then you can talk about during the times that we have a dip of the market, and that hurts actually African governments' physical position because they cannot borrow, and so they cannot use and their economy is not working properly, so there's no revenue, and from the welfare point of view, you can add more. So Ukraine war and maybe the trade war, and see what happens in the commodity market. And this can be one step further, and this is also, you can use this as another robustness test to justify your baseline evidence. So that's something that I would like to add. I'm not going to say I use this to conclude, but I want to tell you, and that's what I'm thinking. After those discussions, we did have a very good discussion today, I think.
Thank you, Hong.
Yeah.
Yes.
Okay.
Thank you very much.
Thank you.
Okay. And so if we do not have more questions, Stella, do you want to conclude on your side?
Yes, I want to thank everyone for the suggestions. There's a lot we've learned, and there's more work we need to do on the paper so that we can improve it. I appreciate all those comments. They make it much better. We had not presented this paper in any other forum. This is the first forum since we put the paper together. And your comments are well appreciated. We will look at them keenly and work on them. And I also want to thank you for giving me this opportunity to present and to also network and get new friends. Thank you.
Okay, so thank you very much, Issouf. Do you want to say anything or?
Yeah, I second what Stella said. Okay, thank you very much, for all the comments and suggestions, actually. As this is the first time, we are presenting the paper outside, actually. Then all the comments and suggestions are very, very, very good, actually, because we are still working on it, and then it will help us really, improve on the paper. Basically, just to come back on really the main question we're looking at, basically, what we really want to look at it, because there is a lot of debate, actually, even on our African continent, that there is a premium on the African debt, right, compared to the rest of the world. Basically, this is really the question we wanted to look at it, actually, and then that's all. And then for us, it was basically, if we look at the commodity cycle, this can help really bring some of the light on this issue, actually. And then that's really was a basic question we're trying to look at in this paper specifically, actually. Yeah. But thank you very much, for your comments, suggestions, and so on. And thank you very much for giving us the opportunity and the great comments, actually. Thank you.
Thank you. Yeah. And thanks for your contribution, by the way. I think we had such a good session today. I enjoyed very much because I was forced to think all the time, since the start of this session, and that is really, really good. So as an academic, we need this type of discussion platform. And I also would like to thank everybody. I think we had so many very, very relevant, constructive questions today. And this is why we need this kind of research activity. And we know each other now. So Stella, first time we met, so very good. So thank you very much. So in that case, we can close the session, and we are doing very well in terms of the time. I hope I can see you sometime later, Stella, maybe in Africa. Yeah, I in Nairobi or somewhere. So thanks for everybody for your time, and let's close this session, and all the best.